Howdy, Jacob here. Today we're looking at EPAM Systems, EPAM Systems in the IT services industry, 11.3 billion market cap on 9.5 billion enterprise value. They provide digital platform engineering and software development services globally, founded in 1993 out of Pennsylvania. Growth outside of last year has been astronomical, from 730 million in revenue to 4.7 billion most recent year, with sadly declining gross margin and a slight decrease in operating margin, with another slight decrease in return on invested capital. But growth is still absolutely immense, and that return on invested capital is still mid-teens, which is very likely well above their weighted average cost of capital, meaning that they are really increasing the business and they don't have to invest much to get a good return on the money that's invested in the business. So $2 billion in cash, 2.1 billion in cash, pretty much no short-term, no long-term. Capital leases are nothing inconsequential to the cash they have on hand. So not concerned with this balance sheet at all. In fact, you might want to even give them a premium because they have 2 billion in cash with less than 200 million in interest-bearing debt. Their cash flow statement has a large increase in cash from operations with a slight, a big increase recently from 2020 to 2022, but 2023 compared to 2014 is not much higher in capital expenditures. Their use of cash is mostly acquisitions and reinvestment, recently buying back a lot of shares. So I think we're ready to make some assumptions here. On the revenue growth side, the most recent year does have very lagged growth, but if they are able to get back to that double-digit growth, that could really help their situation out a little bit. For me, with what I'm seeing, this most recent year being that low, I think they'll make some acquisitions and reinvestments to get back to 10% a year type growth. And in doing so, with their pretty good return on invested capital, I think a 20 PE at the end of 7 years seems pretty reasonable to me. And then for margins, I like to go pretty much in line with what we're seeing right now. Let's do 10, 11. Share change recently buying back more shares, but offsetting stock-based compensation takes about 30% of their free cash flow. 1% for them is about 100. So if they were to buy back with 60% of free cash flow shares, that would be about 1%. So I think I'm comfortable with that. Not paying any dividends. So these revenue and margins are basically assuming that 40 to 50% of cash flow goes towards acquisitions and reinvestment, with the remaining 50% or so going to share repurchases. Again, they don't have any debt, so maybe you want less of a premium because they can use that cash that they have on hand to buy back shares, reinvest back in themselves. They're very net cash positive here through their enterprise value being a bit lower than their market cap. So this could be a very interesting company if they can get back to the double-digit revenue growth. I think that you got a great company, and this is one of those ones where you only want to sell if it's expensive, because if you have a long runway ahead of you with a lot of growth potential, you just want to sit back and wait. You don't want to cut the flowers and flower the weeds, and water the weeds. So interesting company. It's still 35% drop from where it is right now to me with my assumptions currently. But that means that, based off these assumptions, you're probably getting a 7-8% over the next 7 years. So if they can outperform these, then, you're definitely looking at a lot better. So for me right now, I'm just going to be waiting, but really good company and one that I want to own for sure, just at the right price. So I hope you enjoy the video and have a great rest of your day. Thanks.